hiring employees and the pitfalls to avoid, late or unpaid super guarantee payments, and self-managed super funds and commercial properties. Hello and welcome to another episode of the Solve to Evolve podcast. The purpose of our podcast is to provide insights to you, the investors and business owners, as to what's going on in Australia today. My name is Phil and I've got Bloxy and Jono here with me today. Gents, how are we?
Good, thanks, Phil. How are you?
Doing all right. How about you, Bloxy?
Never better, Phil. Never better.
And we made it to episode 12, so we're not doing too bad.
Oh yeah, we're working our way there. Soon enough we'll be at episode 100. So let's just get into it today. There's quite a lot happening in Australia. And I thought we'd cover the three topics: hiring employees and the pitfalls to avoid, late or unpaid super guarantee payments, and self-managed super funds and commercial properties.
So, Phil, we've seen a lot of headlines countless times, actually. It seems a new employer every week, and with Woolworths, Best and Less, even the federal government department responsible for enforcing workplace regulations, making errors on their payrolls to their employees. What's your take on it all, Phil?
My take on it is that the employment system in Australia is a complex one. Employers need to understand their obligations and their responsibility to employees. They need to be aware of the difference when hiring workers, whether they are employees or contractors. They need to be across awards, enterprise agreements, minimum entitlements, contracts. They change pretty regularly, so they need to be on top of that. Now, if, as you mentioned, if the big boys can get it wrong, it means the little ones can as well. All right? And I can't really see a solution, but someone does need to take over and rehaul the employment system in Australia. It's not an easy task, but someone's got to do it to simplify the way we employ.
Yep. So, Phil, if we're talking about or talking to small business owners, what should they be aware of when hiring workers?
Yeah, so when they're hiring workers, they need to understand the difference between hiring an employee or a contractor. The consequences of getting this wrong could be detrimental to their business. You may think on surface that you're hiring an employee, but really you need to look at the substance of that arrangement as to whether or not they would be deemed employees or contractors to the business.
Mm-hmm.
You do need to weigh up the following. So when hiring a person, a worker, what is the degree of control the business has over that worker? Is that worker, in terms of the way they are they paid on hourly, day rates, or are they paid on achieving an outcome? Does that worker have the ability to delegate? And who supplies the tools and equipment?
Yep.
And who also bears the risk? So if you can answer those questions, you usually can get to an answer as to whether that arrangement with that worker is of an employee or a contractor. Now, as I said to you before, if you are hiring a contractor, but they are deemed an employee, if you do get caught, you could be out for annual leave, potentially payroll tax, super obligations, you weren't financially aware of before. And so it's all obviously best before hiring to make sure that you seek professional advice from a HR or employment lawyer, just to make sure you're doing things properly.
And so deemed employee, what do you mean by deemed?
For example, you could hire a person and you could have a contractor agreement in place.
Yeah.
But if that contractor is actually a deemed employee, they will generally be working fixed hours for you, that you would be supplying the tools for them. They're not really working for an outcome, but rather working for you. And so although the contract agreement might say that they're a contractor, the substance of that actual arrangement deems them as an employee.
Yeah.
So you don't want to be caught.
You've got a contract with them, but the laws look at that and say, well, actually, it's employees.
That's correct. And that's because tax law doesn't define what a employee is. And so you've got to look at those rules.
Phil, after seeking advice and determining that a client is going to be hiring employees, what do our business owner viewers need to be aware of?
Yeah, so they've got to be aware of, when hiring an employee, the total cost of employment. And so if it's the first time hiring, well, you've got to think about all the registration costs involved. The employer, the business does need to register for PAYG withholding with the tax office. You need to ensure you've got the payroll system, or at least a payroll provider who will be able to process the payroll for you, but also ensure that you are single touch payroll compliant, which is a new piece that the ATO has rolled out over the last few years, every employer needs to be on that.
That's what's called STP, right? For
That's
short.
correct, STP. So you may have heard that before, that's single touch payroll. And that just means that the ATO now get data from payroll of every employer as soon as possible or as quickly as that statement is lodged. And so the idea is that they can do a lot more data matching when it comes to reviewing tax returns and ensuring
in real
that
time, I guess.
Yeah, that's correct. Just to make sure that employees aren't getting the short stick from their employer. The other thing to consider is you do need to register for an employer default fund. And so that's where an employee may work with you and they don't actually have a super fund for them to elect for their super payments to be deposited to. So you as the employer have that responsibility to make sure that you've got a fund ready for them, because you do have to pay their super on time. And that's every quarter, and we'll jump into that a little bit more. The other thing is registering for workers' comp. So that is a state-based insurance. Depending on where your employees are based will depend on which insurance coverage you get and which provider. Now, once you've got that under wraps, you've got to think about the actual pay that you're going to be offering to your employees. So you might offer them a $100,000 gross wage, but the cost to the employer, to you, the business owner, is not going to be $100,000. We spoke about the registration and the costs potentially involved, but you need to factor in super. That's at currently 11%. You need to factor in how much workers' comp you've got to pay for that salary. And obviously, depending on the industry, will depend on the type of or the amount of workers' comp attributed to that employee, annual leave payouts, and of course, the costs involved in processing payroll.
I think people often forget that, Phil. Like, the administrative costs of running a payroll should not be dismissed. And Phil, for our business owners out there who may be running their business through a company at the moment, what are the pros and cons of that company actually employing the business owner? And what are the options there? Like, is it the only way that a business owner can take money out of an operating company through a salary or a wage, or are there alternatives that might be better or different?
I think most people that get into business, they automatically think, oh, I should be paying myself a wage. And that's because that's what they're used to. But if it is a family-owned business, there are other ways. And the most efficient way is generally to go down the route of a loan and dividend arrangement, which a lot of our clients are on. Now, the benefit of that is you remove the administrative costs involved in setting up payroll, but it also alleviates cash flow. So if you are running a cash flow intensive business, you really don't have to pay any of that tax until later down in the line. Whereas if you are an employee, you do have to withhold at a minimum, generally on a quarterly basis, outlay the super every quarter. And so for a cash flow intensive business, that might not be favorable for them.
Okay. And are there any cons in, if you're an owner operator of a business through a company or a trust or some operating entity, are there any downsides in going the dividend route instead of the salary or traditional wage paying route for our business owner clients?
Yeah, there is a downside as well. So if you're a business owner that really isn't good at managing your cash flow, if you don't have an accountant or advisor that's advising you on a regular basis as to what your tax bill may be when it comes down to it, there is a potential for you to, one, not be able to save enough cash for that tax payment when the company has to pay tax. Or you could be running a business that's in a loss position, but then you're drawing all the company funds, which leaves you in a position where you cannot clear your director's loan. And that's because there's no retained profits to pay out a dividend, and that generally leads to Div 7A issues, which I know you boys can speak on more than I can.
And what about our business owner clients or viewers out there who want to get a loan for something outside of the business? What are the implications of having a stream of income that's a dividend instead of like a salary or a wage on a contract from your employer?
Yeah, a lot of lenders will favour a wage and salary. In most cases, if you do have a good lender that understands how dividends work, they generally will be more accepting because they understand how that works. And typically they want to see, if you are getting paid a dividend, they want to see consistency, and they want to understand that the dividends you're receiving that financial year relate to the income that you produced that financial year. Because as with a company, you could delay the payments of dividends for multiple years. And in that 1 year, you might declare a dividend of X amount that relates to activities for the last 4 years. But that really is a bit fictitious in the bank's eyes just because that is 4 years worth of income. What have you guys seen in this situation?
Where you take drawings, you've got regular drawings. It's always best to check that back to the actual profit of the business. So if you're doing monthly drawings, for example, you should make sure that that's backed up by the P&L of the company.
The profits. Yep.
Yeah, the profits of the business. And when it comes to dividends, I think you really need to be diligent with those, paying your company tax so that you can pay out dividends with your franking credits attached, which we've spoken about in the past. And that's the best way to utilize that structure. If you're not staying on top of the dividend payment, you're not clearing it each year, then you run into problems.
And Bloxy, what's your take on business owners entering into that dividend loan arrangement, how that may affect their borrowing capacity?
Yeah, that's a good question, Phil. I think my take is that it really depends at what point in a business owner client's life cycle and investment cycle they're at. So those who are still looking to grow, for example, an investment property portfolio, or looking to buy their own main residence outside of the operating entity, they're probably arguably better off entering into an employment contract arrangement with their controlled entity at the start. But as the years go by, the external financing requirement kind of, in my experience, kind of falls away. And then they're more efficient and more cost efficient and more flexible in terms of taking cash out to use the dividend and then declare the loan on the following 1 July to clear the balance.
All right, so moving on to the next topic here. Jono, we've seen as of late the ATO clamping down on late or unpaid super guarantee. Can you tell us how they're doing this, Jono?
Yeah, sure. So you mentioned before single touch payroll. So that's the new payroll reporting system, and you're doing that as you make your payments to employees and submitting those reports to the ATO. So that's one side. The other side is the large super funds. So they actually report their data to the ATO, and in the ATO's own words, they have end-to-end visibility now of super contributions that have, whether they've been paid or not. They're really on top of it, and I'm seeing a lot more the ATO chasing employers who haven't paid their super on time.
So it's like real-time matching to the big super funds.
Yep.
So the wages from STP are getting matched to the payments into the fund.
Yeah.
I haven't seen that happen up until, as of late, since Single Touch Payroll 2 has been implemented by all employers by the due date. So over the last few months, as you said, there's definitely been a larger increase in SGC reviews or super guarantee reviews.
Yeah. So, Jono, super's due 28 days after the end of each quarter. The funds need to reach the employee's count before that date, otherwise it's considered late. Can you just give us a bit of background? Can you just tell us about the implications for super being late or unpaid by the employer?
Yeah, well, maybe just at a high level first, you got to remember the ATO and the market kind of see super contributions as your employees' retirement funds. So if you're not paying it on time, you're potentially costing them in retirement. So that's the backdrop and the philosophy behind it. But some of the implications, if you don't pay your super on time by the 28 days, there's penalties and interest on top of that super. You have to lodge a statement, additional lodgement you have to do. And on that, you'll put the amount of the contribution. There'll automatically be some interest applied on top of that. And that reflects that loss of earnings that the employee, if that money was sitting in the fund, it would have been earning income. So you've got to pay that essentially to reflect that. There's also the other hit that happens if you pay late is you actually don't get a tax deduction for those contributions that you paid. So it's like a double penalty. You're paying interest and admin fees on top, and then you are losing a tax deduction for that payment. That's one that's often missed as well. And I mean, typically the other one, like the ATO is not going to enter into any negotiation on this. Like, it's non-negotiable. It has to be paid, even in a sense where there might be a business hardship or insolvency. There are options for small businesses restructuring, but you're never going to get out of super under any circumstance. So it really has to be.
Just to stop you there, just going back to the first point you made about penalties and interest. So if you have a client or if any business owners out there haven't, let's just say 2 years ago for one of the quarters, they made a payment to one employee, but the other employee they completely missed. Is interest calculated on the shortfall of that one employee or the total?
Yeah, so I would think, and correct me if I'm wrong, they'd lodge a statement for that super payment, that payment that was missed or returned from the fund. Sometimes it happens if you don't have the right details for the employee, which is part of the payroll process, and the hiring is getting that choice of super fund, which you talked about. And sometimes that, super funds change and then it gets refunded. You would have to submit a statement for that and pay interest on top.
So just going back to your points about the implications of unpaid super.
Yeah, so I suppose the message is for business owners, if you're listening, is to be wary that the ATO has all the data now, they're checking. And the other thing, just thinking forward, super is currently at 11%. It's going to 11.5% next July 2024. The year after that, it'll be at 12%. It's a big part of the package and the cost of hiring an employee. And the other thing is, so that's the next 2 years. The year after that, 1 July 26, it was announced in the budget most recently that there'll be payday super. So the same day that you pay your employees their wages, on that same day you'll be paying super as well, instead of waiting to the end of the quarter and paying by the 28th. It's something to get on top of now for business owners.
Yeah. Well, I guess once payday super is introduced, we won't have to do any super guarantee charge statements because ideally they'd all be paid on time.
I think that's the idea of the change.
I think it'll be a good change.
I think that's right. But obviously it'll still come down to the business owners managing it with their advisors.
Of course.
Yeah.
Now, Jono, just a last question on this. How can employers ensure that their super is paid on time before these changes happen? So what can they do?
I think they can work with either their bookkeeper or their accountant. And look, if you look at your accounts each month, you might have Xero or Mile, whatever you're using. You should see that liability building up and maybe highlight that or have it on your watch list so that you're seeing, okay, what is that super liability at the end of each month? And you've got that cash in the bank. Some business owners or bookkeepers like to have a separate account to put the cash in there. Then it's, you can pay it out of that account. That's up to you whether you do it that way. But just being highly aware of what your liability is at any point in time and having good process to make payment of it.
Yeah, and guys, just a question. If a business owner does have unpaid super for a long time and don't do anything about it, does the ATO have any special powers to get that super or that super amount that's due to employees?
I think there can be things like director penalties for unpaid super and employees withholding. If it's a company that's running the business, then the ATO can go after the directors personally for that liability as well.
And I'm just going to throw this question out there. What happens if a business had those liabilities and they were looking to liquidate their company?
That's probably one for their insolvency experts.
Yeah.
If you're
I think
in that
though
situation.
that in that situation, employee obligations always rank ahead of every other creditor demand, even the liquidator's fees, I think. But that's a little bit technical.
Yeah.
But you're right. So employee obligations that are outstanding at liquidation rank, I believe, first in the queue.
Yep. So important to get it paid in. Not to throw it up after. Otherwise, the ATO can come after you personally. Now,
Correct.
Moving on to the last topic here. So, Bloxy, we've actually seen a rise in our client base wanting to set up a self-managed super fund, but to purchase a property or commercial property. Could you tell us why someone would want to do that?
First thing to say is that commercial real estate inside a self-managed super fund, it's not common. So it's more the exception than the rule. Most self-managed super funds that are set up are not set up to purchase commercial property. Having said that, there is a large amount of self-managed super funds, and it's growing as well, that have commercial property in them. And part of the reason why is because commercial properties can be used by business owner clients in running their business without breaching the in-house asset rules. So it's an exception to what's called the in-house asset rule.
Yep.
So if you're some kind of professional, an architect, you can have your super fund purchased from a non-related party, an office to work out of, and your business can lease that from your super fund, and you can actually show up every day and work in that office.
Yeah.
So that's probably the first reason why. And then there's more broadly, there's other reasons why. Like, so for example, a business owner client might not have enough cash personally outside of super to purchase a property, either outright or with debt. So they may have to access the funds in their super fund to get that property that they want to hold sooner than they otherwise would be able to.
Yep.
They may also just think that you may be a business owner client, or maybe just an employee client, and you may just think that a particular property is a good deal. If you think that a property is a good investment and you want to put your super into it, you can do that through a self-managed super fund, whether it's commercial or residential. And finally, I guess another reason why more and more commercial properties are showing up in self-managed super funds is because business owner clients may have a need for a business property to be held. So where that happens, like in our client base, like we've got a lot of guys who have big trucks and they need to be secure stored because we've got a lot of trading stock on them. So a lot of those guys need secure storage. They need a warehouse with a mezzanine level in it so they can drive in, the truck in there. It's not sitting in their driveway. It's not out in the weather. But that's just one example of thousands of where there may be a business need for commercial property, and that's why more and more of them are showing up inside self-managed super funds.
So that's some of the benefits of doing this. Can you tell us more about how would the SMSF need to be set up to be able to purchase that property?
Sure, that's a good question, Jono. And the answer is that what we're honing in on here is what's called a limited recourse borrowing arrangement. And to get to that place, which I'll explain what a LRBA is, but to get there, you need to have a very specific structure in place. So the big four banks have pulled out of lending to self-managed super funds. So now we've got a market that is predominantly boutique lenders, and they need very specific structures in order to park a commercial property inside a super fund. So the specific structure that pretty much all of my clients have used to do this is one that's called a sub or custodian trust. So you have to, first of all, you have to have a super fund, self-managed super fund that has a corporate trustee.
Yep.
And then you have to have a sub trust called a custodian that also has a corporate trustee. Now that sub trust, the custodian, holds the interest in the land and pays the stamp duty at the start. So the buyer in the contract will be the trustee of the custodian. The asset will sit in that custodian trust until the mortgage is paid off by the super fund. So even though the custodian trust is the entity, the one that sits underneath the super fund that holds the land, the super fund's bank account is where the loan repayments of interest and principal come out of to go to the bank or to the lender.
So the loan is from bank to super fund.
Correct. The security is, now we'll come back to the structure of the loan. So the structure of loans inside a super fund, if you can't pay for that asset in cash with your super balance. Okay, so this is only for people, and most members do need to borrow money to buy property inside super. Some don't, but most of them do. If they have to do that, the reason why custodian is required is because the only way that a super fund can borrow money is in what's called a limited recourse borrowing arrangement. And the reason for that is because a super fund is designed primarily, its core purpose is to pay retirement benefits to the fund members after they retire. Now, leverage is not part of the equation for a conservative investment vehicle. And so the law forbids a super fund to lend, to borrow. So you can only do it through a very specific structure that we've just explained. It's called a limited recourse borrowing arrangement. And an LRBA, or limited recourse borrowing arrangement, is where the loan, the risk of the loan shifts to the lender. So the lender says that, okay, I'll lend you this money, and the only recourse that I have to claim back security if you default on a payment is the actual asset that we have lent against. We don't have access to the other assets sitting inside your self-managed super fund. You may have shares, you may have cash, you may have bonds, you may have bullion, whatever over here. That is all legally quarantined from the asset that we have lent on.
Yep.
So A, it's legally quarantined and that satisfies the super law. And B, it's legally quarantined inside its own custodian trust. So we have access to it and that satisfies our lending requirements. And that is the basis upon which the exception applies, that you are able to borrow to buy an asset inside super from both the super law and the lending law side.
It does sound like a little bit costly if you want to go down that route, just because you are setting up more entities and dealing with other parties to get that set up.
It is slightly more costly because you have to have, first of all, you have to have a super fund that has a corporate trustee. You can't have individuals as trustees, so you need to pay ASIC any corporation fee for that, for the trustee of the super fund. And then looking at the custodian trust as well, that one also needs a corporate trustee. In most situations, lenders will require that there's two separate trustees on two separate trusts.
Yep.
The super fund and the custodian. And so you will have to pay two sets of ASIC fees to set it up. You have two deed preparation fees, have the duplicates as a renewal fees, and it duplicates
Financials.
Costs. So it is more expensive to do it.
So Blox, why would someone do it and what are the benefits?
Obviously, it's the same as any time that you switch from leasing an asset to actually buying that asset or to owning that asset yourself. You stop paying rent.
Well, you're paying rent most of yourself.
You're paying, well, that's right.
Yeah.
What I should say, you're the owner. So it's the difference between leasing an asset and owning it.
Yeah.
That's probably the main one. Also, you get control and visibility over the assets that your super fund is invested in. So instead of investing in a retail fund where you get a statement once a quarter or once a year that says your unit price has gone up or down based on some market variable, you can actually see the asset and you're using the asset and you're paying for the asset, that you can actually see it sitting there every day.
Yeah.
And that kind of control and P&L visibility over what is happening in your super fund is probably more a general benefit of investing through a SMSF, but it applies, in particular to people who can physically show up to their core asset every day and see it, touch it and feel it and use it.
Yeah, I guess the other benefit, which is for all asset classes, is once you hit that retirement age, you can sell and that becomes tax-free inside your fund.
Well, that's an important consideration as well, Phil. People, our business owner clients out there or others who may be watching should be aware that there is some contentiousness or some contention around the ability to invest all of your superannuation funds into one asset. One of the key underlying rules of investment is diversification. Critical risk, and one that is still simmering away underneath the covers, so to speak, is should, from a policy perspective, people be allowed to not only leverage, but also fully concentrate into one asset inside a super fund. Part of the reason for that is because the superannuation law requires that a trustee matches its pending liabilities to its asset mix. For example, if you have a member who has 60 years of age and retire soon, some people in the super space have argued that it is inappropriate for that fund to be allowed to continue to hold one asset only. It's clunky and it may not be generating the yields to pay the pension that member expects to be paid in the next 4, 5, 6 years, whenever they retire.
So what would be the option? How do you unwind this? So if an investor or business owner bought that property, how would they realize the value of that if they had to?
So the primary way is to sell the asset.
Yeah.
But probably a smarter way to go about this is that to make sure that your clients who have your concentrated super fund usually in one piece of land, that they are aware of the requirements to match their asset mix to their pending liabilities, and to build on the side of the property more liquid and divisible assets on the side of it to make sure that it gives them time when members do reach that retirement or that transition to retirement stage, to sell down part of their portfolio to pay obligations as they come online, and then to work over a number of years to make sure that they can realise the land asset, the big one, at the most beneficial point in time in the market.
Yep.
Yeah, so potentially it can be complex, especially if you have a self-managed super fund with family members, some who are closer to retirement than you are. If they're about to hit that point, you do need to make sure that your super fund has that liquid asset to be able to pay that pensioner.
Yeah, correct. That's right. Clients really need to be aware of that. A lot of clients who do this tend to be on the younger side. And so it's a kind of a process of coaching them over the years to make sure that they have enough liquid assets on the balance sheet on top of the property to meet obligations as and when they arise.
Excellent. Now, Chris, just to wrap up, we touched on costs and complexities. Are there any other cons about having a self-managed super fund and purchasing a commercial property?
Well, just general clunkiness of a big asset. If you have a commercial tenant and your commercial property goes vacant, it's harder to find a business tenant than it is to find somebody who needs to live somewhere. So commercial property is always harder. They'll pay you higher yields. The reason why you get higher yields from a commercial property is because of
risk.
The oldest relationship in the world between risk and reward. The higher the risk, the higher the reward. Yes, it's clunky. Yes, it's a little bit hard to re-tenant, but that will mean that you can get 10% plus returns on commercial properties.
Just the last question for you, Bloxy. So the viewers out there might be thinking about, okay, we've been talking about commercial property, but can a self-managed super fund have a residential property?
Absolutely. The main risks that I've seen around residential properties inside super funds is that you have to be very careful that no members or associates actually use that property. So if it's on a nice kind of holiday beach golf course up north somewhere, if it's sunny all year round, you need to be very careful that the super law says that you can only, either a member or a member's associate can only get benefits from the super fund when a condition of release has been met. So if you have not met a condition of release, but you are getting benefits from an asset sitting inside your self-managed super fund, an audit can pull you up, you can be breached, and that can have serious ramifications. Yes, residential properties can be used, but please be careful that you're using them the correct way and in accordance with the super law. Otherwise, you risk breach notice becoming non-compliant.
Thank you, Bloxy. That's all we have time for today's episode. Thank you again for joining us. And if you found today's episode valuable, please share this podcast with your network, and we would love to see you next episode. If you had any questions about what we spoke about today, please email us. Find us on LinkedIn. Our email is podcast@solveaccounting.com.au. Until next time.